Record. There you go.
Well, as we get started here, I just want to, Anuja, Jean-V, and Christian in particular, I know you've all been working hard behind the scenes to make this happen. So thank you very much. Josh and I are happy to be here and, for the inaugural presentation for the Northeastern Options Club. So, this is, the first of many, we hope, and, many years going forward. It'll be a give and take combination of options education, presentations, coupled with using the Delphian platform. So, happy to be with you. We'll get started. A little bit about myself, basically, was lucky enough to trade options for 23 years in Philadelphia on the exchange. I'm just outside of Philadelphia now. My colleague Josh is down in Tampa. So traded options for 23 years, all kinds of markets over that period of time. And then 11 years following that, I had the opportunity to teach options, as an industry representative for the OCC, the Options Clearing Corporation. And then a little over 2 years ago, was lucky enough to join Delphian, and we're moving forward with the Delphian platform. So before I get started, with the presentation, Josh, how about if you tell everybody a little bit about yourself?
Yeah, sure. Yeah, thanks for everyone for inviting us. We're excited about this opportunity, to teach you guys some stuff, that we've learned through trial and error experience, stuff like that. So I've been with Delphian for about 7 years as a trading analyst, so kind of the go-to for the platform. And before that, I was an advisor with Wells Fargo, then Merrill Lynch, and probably been about 11 years in financial service industry. Before that, I served as a naval officer aboard ships for about 12 years. So that's my experience. And I've been trading for a long, I don't remember how long. Like, I remember in high school, I kind of started, just getting interested in it. So, done commodities, trading, options for a long time. So excited to be here, and you guys feel free to ask questions. Back to you, Joe.
Okay, yeah, we got the chat box. So as we move through this, feel free, maybe that's the best way, through the chat box to offer any questions you may have. So, before I get into core option concepts, I want to offer just a little perspective on the options industry. The options industry started in 1973. We're talking the listed options industry on the Chicago Board Options Exchange. That was the first exchange. Currently, there are 6 parent companies: the Chicago Board Options Exchange, the Boston Exchange, MEMEX, the Miami Exchange, NASDAQ, and the New York Stock Exchange. They all have option exchanges. Some have multiple exchanges. Right now, there are a total of 17 option exchanges. Okay. The industry from 73 to the year 2000 grew slowly. When the industry started in 73, there were 16 companies that had options listed on them. Currently, it's close to 6,000 different companies, ETFs, and indexes that are listed on the various exchanges. So from a volume perspective, they say from 73 to 2000, slow growth in the industry. What changed in 2000, we had the first electronic exchange start. It was called the ISE, which is currently owned by the NASDAQ. That really changed liquidity in the markets. It improved, executions, and bid offer spreads became more narrow with the advent of electronics. And so the industry began to grow. The first year, I think the industry traded 1 billion contracts was around 2003. And by 2019, 2020, the industry was trading little over 4 billion contracts a year, which equates to about 19 to 20 million option contracts trading each day. Okay, so in 2019, 2020, we were doing, which at that time was record volume in the industry, 19 to 20 million contracts a day. The last couple of years has just been explosive in terms of options growth. We're up to, 44 million contracts trading a day. So, industry volume has more than doubled in the last couple of years, and lots of reasons for that. But I think bottom line, options are great financial tools. And getting back to the presentation, core option concepts, there are really a lot of negative feelings about options out there. They're too complicated. They're too risky. I think a lot of that is just bad press. It's really not true. It's presentations hopefully like this, and as we move forward, giving you the opportunity to build a foundation of knowledge in listed options will allow you to use them for all kinds of different reasons if they suit you. So, with that, I think we'll get started with the core option concept presentation. Let's see. Okay, here we go. What are options and why do we use them? Options are contracts. They give the buyer the right. The buyer of an option contract has the right to buy or sell the underlying asset, whether that's a stock, index, or ETF. The seller takes on an obligation to buy or sell that underlying asset at a specified price, and that's the strike price. So if you don't know options, this whole concept of strike price, as you'll see as we go through, is critically important. Okay? Buyers pay for the rights, sellers get paid to take on the obligations. Two types of options, calls and puts. Again, not sure, how many of you have either used options, studied options, but really, they're very straightforward if you get your base of knowledge. Each equity, index, or ETF option contract represents 100 shares of the underlying. That's, critically important to understand, not difficult, but every option contract you buy or sell corresponds to 100 shares of the underlying. Paul buyer gets the right to buy 100 shares of that underlying index, ETF, or individual company. You buy an option contract, essentially you're long the contract. For a call, you're long the call contract. Call sellers take on an obligation to sell 100 shares of that stock, index, or ETF. And the lingo, if you sell a contract is you're short the call contract. Now, the flip side is the put buyer. The buyer, again, purchases a right, but that right is to sell the underlying stock at the strike price. You buy a put, you're long that contract. The put seller takes on, again, an obligation. But unlike the call obligation, which is to sell the stock, seller of a put takes on the obligation to buy the underlying stock. Okay, you sell the put, you're short the contract. Unlike stock options, unlike shares of stock, options do expire. Each contract has specific terms. You've got 100 shares of the underlying, and then you've got that specific expiration, the contract specific either daily options, weekly options, monthly options, and then we have longer dated options that are called leaps that can go out 2.5 years. We've also got customized options, which are called flex options. Again, what are options and why do we use them? Options are used, for a number of different reasons, but, most notably for risk mitigation. income generation, and then also, for stock acquisition. You may have different reasons, but they're the three primary ones. Now, put buyers, have the right to sell the underlying stock at the strike price, but sellers have the obligation to buy the underlying stock at the strike. Let's look at an option contract. One example. XYZ December 15th, 2023, 45 call at 550. So if I'm down on the trading floor, and now so much of it is electronic. There are still some trading floors, but it certainly isn't the way it used to be. So this example, again, is XYZ. That's the underlying, represents 100 shares of the underlying. The expiration date is December 15th, 2023. Strike price or exercise price, is 45, because again, it's the XYZ Debt 45 calls at 550, and the option price paid or the premium is $5.50. Now, $5.50 is the price of the option, but because every option contract corresponds to 100 shares of the underlying, you got to multiply 550 by 100. So each option contract corresponds or costs, if you buy it, and you collect if you sell it, $550. So, try to be clear. We got calls, we got puts, we got rights, we got obligations, and we've got specific terms, especially, that strike price and expiration date. Other things to understand about the option price itself are intrinsic versus time value. We've got in-the-money calls and puts. So in the money suggests that there is some intrinsic value. Have intrinsic value. They may have time value. Okay, and they're really the two components of an option price. Potentially intrinsic value, and above that would be the time value. Next are at-the-money calls. At-the-money calls have no intrinsic value. The value of that option is made up strictly of the time premium. And then finally, the last terminology is the out-of-the-money call or put. Out-of-the-money calls and puts have no intrinsic value. Any value is all time value on the out-of-the-monies. So, any call or put, will have some time value unless, potentially the option's expiring same day and, right up to expiration, there's going to be some time value. The longer, the option exists, the more time value you'll have, the more volatile the stock is, the more expensive that time value is. We'll go through some examples to clarify intrinsic value next, but you can see the in-the-money calls and puts do have intrinsic value. At-the-money or out-of-the-money puts have no intrinsic value. Let's take a look at it. Calls in the money. Strike price is below the stock price. All right, so here we are. The in-the-money calls for the stock at $50. With the stock at 50, the in-the-money call has some intrinsic value. And why is that? Because, what does that $40 or $45 call represent? You buy that contract, it's the right to buy stock at 40 or 45. If you're buying the right to buy stock at 40 and the stock's 50, you've got $10 of intrinsic value. So that's the in-the-money amount. You're buying the 45 calls, you've got $5 of in-the-money amount. Pretty straightforward. Again, options really are straightforward, financial tools, not complicated. It's just a question of, understanding some of the language. So the in-the-money amount, for the 40 and 45 calls are in the money because the stock's at 50. The at-the-money call with the stock price at 50 would suggest, options with a $50 strike. All right. And then the out of the money calls, the 55 and the 60 calls, that strike price is above the stock price, no intrinsic value. Any value to that option would just be time value. And, there are, each option, represents a different contract. The 45 call strike is the right to buy stock at 45. The 50 is the right to buy stock at 50. And the 55, is the right to buy stock at 55. I mean, different underlyings have lots of different strike prices. You may ask yourself, the stock's 50 and, a stock's got a $60 strike. Who cares about the stock at 60? Well, maybe there are circumstances that have that stock appreciate substantially, so you can buy an inexpensive option that will, increase in value dramatically as the stock goes from 50 to 60. All right. So, that's why there are lots of different strike prices around the underlying price of underlying stocks. Puts, you flip things around. You've got out of the money puts where the strike price is above the stock price. With the stock 50, those $40 and $45 puts would be out of the money because they represent the option to sell stock at 40 or 45 with the stock at 50. So the stock, the strike price is, above the stock price. The at the money puts, the 50 strike with stock at 50 would be the right to sell stock at 50. And then those in the money puts would be the 55 and 60 puts, because after all, those strikes represent the ability to sell stock at either 55 or 60. With the stock at 50, you've got either $5 or $10 of intrinsic value. I hope that's, making sense to folks. Again, let's go through an example with the intrinsic value versus time value. XYZ at 53, but the Jan 50 call trades at 520. All right, so XYZ at 53, Jan 50 call at 520. I hope it makes sense that the call is in the money by $3, and the extra value, the $2.20, would be the time value. Okay, so again, some options have in the money value, many do not. So the value of those options is strictly time value. How about a 55 call? Rather than the 50 call, if the 55 call is priced at $1.50, is there any intrinsic value in a 55 call? Hopefully, you understand that the answer there is no intrinsic value, because the strike price is above the price of the stock, and the value of time, in this example, would be the whole value of the option at $1.50. Last quiz, just hopefully get you thinking the right way. Some of you may understand this, some may not. Stock price. Okay, again, always looking at the stock price versus the strike price, is going to give you that basis, the foundation for, okay, some idea what the option value will be. Stock price is 77. The 70 call is worth 10.50. That 70 call in the money, at the money, or out of the money? Hope you get that. How much intrinsic value? Hopefully you get that. And then the leftover value, the difference between 7 and 10.50 is 3.50, which is the time value. The 58 stock price, 58.50 with the 60 put. Sorry, I hit that button a little quick. I hope you get that 60 put, the right to sell stock at 60, is in the money. And in the money by $1.50, the balance is the time value. Next, we got the 83 call with the 83 stock price with the 85 call. option price at 225, in, at, or out of the money. Hopefully you get out of the money by $2. No intrinsic value, all-time value. And then lastly, you know, pretty straightforward. You got the stock at $12.50, the options at $12.50 call, the value's $1.50. Clearly that is at the money. So there's no intrinsic value. The time value is $1.50. So, you know, we're not interactive, or at least we haven't been so far. You know, does anybody have any questions in the chat box, you know, about these concepts? Basically, what is an option? Understanding the rights and obligations for calls and puts. You know, next time around, we'll talk more about, you know, the ultimate risk of, you know, being long call, long a put, short a call, short a put. You know, lots of different reasons to use options, but, you know, understanding, you know, this idea of intrinsic value and time value, and the whole concept of in the money, at the money, and out of the money. Anybody with questions in the chat? If not, I can, Josh, turn it over to you to talk to folks about the platform. All right, I will do that.
Okay, we got one question. KP.
Good.
Go ahead.
Just came. Yeah, go for it. KP?
Yeah, can I just speak it out, or like should I type it
Yeah,
down?
Yeah,
Yeah.
go right ahead.
So I had a question. So why is the time value like more than the difference between the stock price and the strike price? As in the last example, we had the third question, like stock price was something 83 and the strike price was 85, and the option price was 2.25. So what's the extra 0.25? Like what does that represent?
The intrinsic value, you're talking about the 83 call?
Yeah,
Excuse me, the 85 call. So
yeah.
time value, and we will get into this, you know, next time. It's a good question.
Yeah.
Time value is priced basically on two things. The amount of time before you get to expiration, that's one component. But then, you know, very important, implied volatility. How much does that stock move? And I didn't want to go there today. We'll do that next time. We're going to talk about risk for calls and puts, but we'll also talk about, you know, some of the Greeks. And implied volatility is the market's expected amount of movement for the underlying going forward. If it's a low volatility stock, the value of time will be inexpensive. If it's a high volatility stock, the value of time will be far more expensive. That make sense?
Yeah, got it. Yeah, thank you so much.
Okay, you're welcome. Yeah. All right, Josh. So
Yeah.
I can, you got control there?
Yep.
All right, it's all yours.
Okay. Welcome everyone. I'm putting some in the chat. So you guys all should have logins. If you don't, then you can just email me. Put that in here. If you don't have your login credentials, you know, you can shoot me an email. I'll send them to you. But this is the link. So the one that you originally got sent out, that's our old one. So we are transitioning to our new interface, and it's a lot easier. So I'd recommend you use that over the old one. It's a lot better layout, less confusing. So, you know, in here, you know, there's a lot to Delphian. There's rabbit holes and, you know, more rabbit holes. So what I'm going to do is just kind of focus on kind of one area I think is important for you guys, just to be able to, you know, get your feet wet. And then, you know, I can show you like a quick overview of the platform. But where I think you guys want to go is into this My Delphian virtual portfolio. So you'll have in your logins just this, you'll have one default portfolio. So you can click in there And what you can do, I think is important, is to start, doing trades. These are simulated trades. So you can see like here, this is SPY, the SP 500 ETF. And, I did a bull call on 1026. So I, bought a call and sold a call. And, we can track how it does day by day. All these options are priced end of day. So there's no intraday pricing. It's just a snapshot at the end of the day. But you can go back, and I have options tables, just like Apple. You can go all the way back to whenever you want, 2007, any day between now and then, and look up all the options tables for, that symbol. So you can see here, this is Apple, and we have the expirations available. This one's November 17th, 2023. So it gives you all the different strikes, the prices, and once again, this is an end of day snapshot. And it gives you like individual volume, open interest. And then these are the Greeks Joe was talking about. There's the IV. Here's the bid for, so this is the call side over here. So for the 165, it's a bid of $7.20, an ask of 730, and then a mid price, which is, between those two. So we have that for every symbol. There's like 4,500 symbols in here. Every day, all their options are available. So how you can use that is, we can go back into our virtual portfolio to start placing trades. If you learn like a new strategy, you can just, put it in here. And so we'll add a position. Let's just say, you want to pick a symbol like Tesla. All right. So we'll go into Tesla, and we'll, there's 27 different strategies. So I think we'll just start something basic like a covered call. So that's buying 100 shares of stock, and then we sell, one contract of a call. So we're getting premium, and we're holding this long term. So you can see, you can select any of the expirations, any of the strikes. So, what I like to look at, okay, we bought this at 2073, and, I'd look at the standard deviation range. So, this is a 65% probability it'll stay within this range, and 95 within this range. So if we want to sell, we can, look at 235, 232, and we can see, the max profit, max risk, lays out all the different, parameters, your probability of profit, and, just overall everything you need to know for that trade. You can also go in and set profit targets. So, if you want to get alerted when you hit 10% profit, then, you'll get an email basically alerting you. And same thing with like the stop loss. If it hits 10% either way, I want to, get notified. And then, you can also say, notify me after, 30 days, 20 days. So that's all you can do there. This is more than my available risk amount. So let's do a different trade, something cheaper. Let's do Coca-Cola. So we'll do it again. All right, covered call. So 100 shares at $55. And we'll do same expiration. And we'll look at like right around 57, 50. It's still more than my risk for some reason. All right, so I didn't set this up, so I can only risk 1% on stocks, but I think you guys get the idea. So then you can save it. All these things you can edit, so this is set up for basically like option strategies. I didn't even look before, so sorry about that. But if we go back to the portfolio. I do have a couple of trades open. All right, so should check that. So we can go back in time and create trades. We can go back to the second. You can go back any date and time back to 07, create trades, and then track those trades over time. So I did this one for Amazon. So I did want to show basically a good learning tool here. So the strategy, if you click the bull put, it'll open up a new page for your strategy, and it'll show you your strikes. So you can see here I bought 110 put, and then I sold 125. So you can, it gives you a nice layout of, here's the prices in the background, and then these are the strikes, and then down below it gives you your daily profit loss. So you can track these over time, gives you a good representation of how things move over time relative to price of the stock. So, this works for any of the strategies, and you can go back and just, put in trades and kind of see how things react over time. So I think that's probably the best place for you guys just to get started in here. Just putting in some positions, tracking them, learning new ones. I have a bull call, a bull put, and just going there, kind of learning how things move relative to the strikes. There's a question: could we directly put a calendar strategy as a portfolio? Yeah, there's the so we have different calendar strategies. Symbol here. So you can see there's long call spreads, diagonals. That's another calendar. Long put diagonals, condors, butterflies. So yeah, you can do those and track those however you want to set those up. It's a little more advanced for people just learning what a call and a put is, but yeah, we do have that capability for the calendars. I saw that pop in. Does that answer your question?
Yep.
Okay. Yeah. Okay. So yeah, you can put those in, track those. I mean, it's just a great tool overall to learn without having to risk your money or anything like that. So that's the virtual. Any questions on virtual portfolio? You can see I use it a lot. Okay, so I also went through the options tables. So just being able to navigate this, you guys, you can also click this. It'll pull up all the 120 strikes for every expiration. So it's just to be able to go back and just look at any option chain going back in time to 07. So I'll just go back to the homepage just real quick, give you a quick tour. So all of these numbers here, that's our modeling. So it's a proprietary indicator that basically tells whether stock's bullish or bearish. It's called state modeling. So anything you can see, anything odd, 1, 3, 5, or 7 is a bullish state, and then 2, 4, 6, 8, those are all red and bearish. So you can see, the market's really bearish right now. This just gives you a market overview. These are all the different sectors, and this is all 4,500 symbols, whether they're bullish, bearish, and where they're located. So we have 62% in our most bearish state, which is overall bad for the market. Down here, yeah, we just have transitions like, okay, this went into the most bullish state. We had 9 of them. We had 68 go to the most bearish. And we can get into this more, but I did want to highlight, down here, there's a YouTube channel. And there's, these are off the old platform, but they still pertain So like this is the modeling overview. And this is all in the member orientation, which is linked down here on the home page. And we have different ones for seasonality, options chain, there's paper trade options. So that's the virtual portfolio. So if you need to go back in, this will explain everything, how to execute things in there. So that's our YouTube channel. I'll put that just in the chat. And I think we'll end up posting this onto the channel just so you guys can access it. And we have weekly meetings too. You guys can tune in those. Let me know if you want to, or you can watch replays. It's like experienced traders that we have, and we do a market update with all the modeling and talk about earnings and things like that. So that's a good resource overall. Just if you get stuck quickly. So this is a research platform. We have different things. We have our analysis. This is modeling. We have a screener, sector analysis, charting, and then fundamental data. So like the overview for Delphian analysis is we'll do pretty good deep dive into the symbols. As far as different news, historical news, earnings, insider trading, things like that. So you guys can play around with it. You're not going to break anything, so don't be bashful. This is our modeling. So just like a quick snapshot. This is USO. So this is the oil ETF. So basically, we predict based on past occurrences, how long it'll be in here, 36 trading days, how high it usually goes, about 12% higher. And then, it gives kind of maximums that it's hit before, in a year. And then we give targets. So you can see down here is our stop loss. So it's at 75, didn't really get, got close to it, but didn't touch it. And then we have 3 different targets, basically like conservative, and then like an aggressive target and kind of median. So the average move is going to be right in here between 2 and 3 every time. So, the typical kind of pattern, it goes kind of like this. And then, maybe like 30% it'll go higher. And then the other 70 it'll come back down. So that's just like the quick, and you can see down here, here's all the states. So, 8 is bearish, 1, bullish up here. So like when things get really bullish, they'll do like 1, run up, have a pullback, which is 2, get in 1, run again. So they do like 1, 2, 1, 2. And then on the bottom, it's like 7, 8, 7, 8. It's kind of when things are really bearish. Any questions on that? Okay, go back to so that's just, feel free to click through here. There's lots of good, information, fundamentals, sector analysis stuff. Next tab is earnings. So you can do individual company analytics on Apple. If if the stock goes up into earnings or down into earnings, after earnings, does it typically go up or down? How big of a move does it normally do? So that you can go and do an individual analysis on this. We do a quarterly plan for earnings that we do for our customers, and that we push those out via trades. And you guys aren't on that list right now. So trade ideas. So this you will receive. These are daily trades we've back tested. So the whole back testing, that's like 45-hour lecture. But in here you can go and learn, kind of quickly if you really want to get into it. Take some practice, but once you get it, it's pretty easy. We have an option screener, so this will find candidates for you automatically for like a covered call, married puts. You can put in the symbol and the different characteristics, add it to your portfolio and then, track it. It's a good way to learn, obviously. And then, same thing with like our trade scanner. So this is like seasonality. And this is the last one I'll cover. So this one's really cool. It's just that trade ideas trade scanner. So you can go through and do different strategies and tweak the numbers. So like profit target of 15, and you get instant feedback. So it's a really good tool just to learn trade-offs. I mean, all of this stuff, when you're doing options, it's a trade-off. Like I want more gain, so the risk is going to be higher. Probability will drop. If you're trying to get a bigger profit, your win rate's going to go down. If you're going to do, a deeper in the money call, you're going to get less reward. So it's just all trade-offs, and you can just, go through and change things, like the strikes and everything, and, just kind of analyze them, and you get instant feedback over here. Okay, does it go up or down? Why did it do that? So it's just a good tool, just kind of, mess around with and, learn, how to do the trades, and then, the trade-offs that happen, like when you change things. So I think that was probably pretty good. I don't want to overdo it. Any questions on those? So really it's, I think, the virtual portfolio is a great place. And then, these trade ideas, the scanner and the option screener, those kind of three places I think are, where you really can learn quickly, how things apply. So we'll open up to any questions or comments.
Yeah, either on the platform or about options. And Anuja, yeah, any comments?
Yeah, so I think I just want to request everybody to try out the platform if you already haven't. It's a great platform just for learning, tinkering around. You can explore the different things that Josh said in this session, and hopefully by the next session, everybody will be more familiar with it, because this is very interesting and this was a great learning experience for all of us. So thank you, both of you. And I think we have a question in the chat, so I'll let that person speak.
Yeah, go ahead, just unmute and fire away.
Hi. So I think when you were just looking at the trade-offs, I think in the back testing, there was a term called strikes from leg. Could you maybe, could you tell what that is about?
This strikes from leg,
Yeah.
right? Okay.
Yeah.
Yeah, so there's a lot of different options here. So what this is doing, like if we go back to this, so I'm selling the lower right above the lower standard deviation, right?
Yes.
So this standard deviation would be 155, right?
Yeah.
So I'm selling below that, so I mean above that. So it's the first one above 155. So I'd be selling this one, right? So for Apple, for applying it to this option chain.
Okay.
So from there, we had, I'm buying two legs below this one. So what it does, selling this and then buying two below. So 1, 2. So that's the structure of my trade, right? So I have, let me get the tool real quick. So I'm selling this one and then I'm buying this one, right? So if I did 3, you move down here, if we do 1 here. So it just, it all pertains to, this option chain and how it's selected. So, you can do like a delta. So if I do a delta of 60 on the put, so good Lord. So 60, I would be doing, here's this delta of 60. So there I'd be selling this one, and then 2 below, I'd be buying that one. So there's all different ways to select these, upper, lower standard deviation, delta, expected move, percentage from, points, strikes. So just different way to, select the strike. And the same thing here. I could do these both deltas, right? So I could say 60 and, 50. So just however you want. Obviously, it gets a little complicated. I just did, this strikes from leg. Just it's a lot
Yeah.
easier to understand initially.
Yeah.
But it's all about just how it's picked from here, right? So, if we say 30 days, then it's going to do minimum of 30 days. So that's 21. So look out for the next one, 28. No, next one, there you go, 35. So it'd be looking at, that. Or
Okay.
if you're saying monthly, it'd be the next monthly, that's at least 30. So it'd be, this one here. So it's
Okay.
that's all like, you got to think like a computer, like how it applies, these rules, how they'll pick things out of, the options chain.
Okay. And we can work around with numbers, as in like if I'm buying two puts and I'm selling one, so maybe I can maybe work around with the ratio as well, right? Like I can maybe buy four and maybe sell more, something like that.
I don't know if I have too many like the ratio trades. What you can do is just, do them individually. I don't think we have the ratios just for like basic trading for people, but you can do in the virtual portfolio, you can just do two trades separately. And then I don't know if we have that combined feature, but yeah, you can do them separately and then kind
Yeah.
of track them together.
Yeah. Yeah. Okay. Makes sense. I can try that. Okay. Thank you. Thank you so much.
Mhm.
Anybody else?
Okay. Yeah, great question. Okay, I'll turn it back to you, Joe.
Yeah, I think, anything else, Anuja?
Nothing from my end, but it's already overtime, so I don't want to take too much of your time also. Thank you again, both of you, for spending so much time with us, explaining all the details to us, and we look forward to having more sessions with you.
We do too. Thank you all for joining. Thanks,
Yeah,
Ash.
thank you.